Welcome everyone. My name is Robin. I am a senior business analyst at GeekyAnts. I have an experience majorly working in fintech projects, which includes payment gateways, digital banking, and building loan applications. In today's session, we will explore the critical aspects of digital lending, focusing on loan products, loan cycles, and compliances requirements in the fintech sector. Whether you are a lending professional, an investor, or simply curious about how digital loans work, this session will give you a clear understanding of the ecosystem. Why does this topic matter? The fintech lending space has transformed access to credit, allowing seamless loan approvals and digital disbursement. However, with innovation comes responsibility, ensuring fair lending practices, regulatory compliances, and robust security to protect customers and investors alike. So today's agenda of the presentation will be breaking down of different loan products in the market, understanding the loan cycle from application to repayment, key regulatory compliances, and security protocols required in digital lending. So let's get started. Understanding loan products. Let's first discuss the type of loan products commonly seen in digital lending ecosystem. Overview of digital loan products can be defined into short-term versus long-term loans. Short-term loans typically ranges from 6 to 12 months, oftenly used for emergency funding, working capital, or education. Whereas long-term loans, usually above 3 years, ideal for housing, business expansion, and structured finance planning. There are different types of loan categories under these two types of loans. First is the personal loan, then comes the SME business loan, then comes the educational loans, and at last it's buy now, pay later products. Let's dive deep into the case study of our digital educational loan products. Mainly, digital lending platform provide customized loan schemes catering to educational financing. Let's examine two such models. The first model will be the short-term monthly repayment scheme where we call it as month over month as well, where it is designed for a single academic year for an institution with a flexible tenure of 6, 9, or 12 months. The loan amount equals to the total institution fees paid directly to the institutions. Lower interest rate if the institution is partnered with lending platform. Higher interest rate if the institution is non-partnered. Then comes the long-term loan scheme. In long-term loan scheme, a structure plan of a multi-year educational financing that ranges more than 3 plus years. The loan amount increases annually with inflation adjustment, with fixed EMI model to keep the repayment predictable. Foreclosure options available if the borrower relocates or no longer requires the loan. How do lending platforms optimize the profitability? Lower interest rate or trusted institution of increased adoptions. Commissions from partners generate additional revenues. Return of investment based structure payouts ensure secured investor returns. Now let's understand the loan products. Let's break down the loan cycles, how a loan moves from application to closure. There are various stages of a loan cycle. The first stage is loan application and approval. Borrower submits a loan application via digital platform. AI powered risk assessment evaluates creditworthiness based on income, employment, and past credit history. Then comes the credit limit and loan tenures that are determined. The second stage is loan disbursement. Approved loans are disbursed directly to school slash vendors for educational loans or borrowers for personal slash business loans. Investors backed escrow accounts are used to ensure fund liquidity. The third stage is repayment cycle. Monthly EMI payments through ENAC mandates. What is ENAC mandates? ENAC mandates are the automated deductions from bank accounts. The real time transaction tracking ensures timely payments. The fourth stage is handling late payments and defaults. There are various loan status that are there involved in handling the loan statuses. The first is the outstanding, which means loan is active, EMI is due. Then comes overview, which means EMI unpaid beyond due date and late fees are applied. Then comes delinquent, non payment for 30 plus days flagged for collection. And the last is NPA, which means non performing asset. 90 plus days of overdue, which will lead to legal actions. The last section is foreclosures and prepayment. Borrowers can prepay loans before the tenure ends. Prepayment charges may be applied in certain cases. Now, the second part of this is to understand how the money trail in digital lending flows. The first part is fund flow. Investors deposit funds into an escrow account. Loans are disbursed from escrow to the various institutions or the business partner. Then comes borrowers repay EMIs based on the credited back to the investors. And there is a transaction monitoring. AI driven fraud detection to prevent unauthorized transactions are there. Manual interventions for disputed or failed payments are also being there. Compliances and regulatory requirements. Regulatory compliances is critical in any fintech lending platform. Let's explore key regulations and security measures that must be followed. The first part will be we will be covering the key compliances guidelines for any digital platform. The first is based on the RBI regulations for fair lending practices. The first part given by RBI is full transparency on interest rate, APRs, and fees. No automatic increase in credit limits without borrower's consent. Borrowers must have a clear grievances redressal process. The second part given by RBI is to have a proper know your customer, that is KYC, and anti money laundering AML requirements. First is borrower must undergo digital KYC verification, which contains your Aadhaar card and PAN card details. Second is platforms must prevent fraudulent identities and money laundering. Third part is data protection and cybersecurity compliances. There are various encryption standards such as AES 256 encryptions for sensitive borrower data protection, secure authentication, multi-factor authentication, that is MFA, for all financial transactions are implemented. API security, controlled access to financial data using OAuth 2.0 is also a mandatory. Fourth part is grievances redressal mechanism. Borrowers can file complaints to RBI Ombudsman scheme. Resolution required within 30 days as per the regulatory mandates. The second part of this is regulatory reporting and licensing. Digital lenders must be registered under NBFC P2P regulations, regular reporting to credit bureaus for loan performance tracking. Compliances like GDPR data privacy laws are also applicable. Conclusion and final thoughts. Key takeaways from today's session. Loan products vary between short term and long term. Loan life cycle involves multiple stages from application to closure. RBI mandates ensure fair lending, data privacy, and borrowers' protection. The future of fintech lending as a digital lending continues to evolve. Compliances and innovation must go hand in hand. Problems that integrate AI risk driven risk management, automation, and regulatory compliance will lead the next wave of fintech success. If you have any questions or need further insights, please feel free to reach out or drop them in the comments below. Thank you for joining this session, and I hope this has been insightful. Thank you.